housing cancellation rates have spiked to 20% as 1 in 6 first-time buyers falls behind.
Nick Gerli of Reventure Consulting tracks these defaults, while ARK Invest explores a massive leap for SpaceX.
Our AI-powered summary breaks down that $100 billion revenue goal and the hidden signals in the job mess.
SpaceX just held its first earnings call as a public entity, and the focus was heavily on their massive investment in growth.
Exactly. While the street was a bit surprised by the level of artificial intelligence capital spending, the payback period is exceptionally fast.
Is that level of spending sustainable for a newly public company?
The core of the thesis here is that this isn't just spending for the sake of it.
Right. The chief financial officer noted they are seeing a payback period of less than 1 year. It's essentially treated like a cost of goods sold expense. When you have capital expenditures yielding returns within 1 year, aggressive investment becomes the logical path.
Starship remains the critical variable for their total addressable market.
Flight 14 is a major milestone because they will attempt to reach orbit and catch the upper stage. The full reusability is what moves launch costs from $1,000 per kilogram down to under $100.
How is the satellite internet side of the business performing?
It's growing rapidly. They now have over 12 million subscribers globally.
But can they handle that many users without a loss in bandwidth?
The version 3 satellites they are launching provide a 20 times improvement in bandwidth per journey compared to current models.
One of the most interesting tidbits was the plan for terrestrial infrastructure.
They are proposing an additional piece of hardware for home dishes that acts as a localized cell tower. This solves the connectivity issues for mobile satellite service in urban regions by using the customer base as the network grid.
The revenue targets for the end of the year are quite ambitious.
They are aiming for a target of $100 billion in annual recurring revenue by the end of the year.
And that would be a massive surprise to the broader market if they hit it.
How fast are they building out their data center capabilities?
They want to reach 10 gigawatts of compute next year. To put that in perspective, competitors like CoreWeave are only targeting 8 gigawatts by 2030.
Where is all that power going to come from so quickly?
They'll need 20 gigawatts of power to support it, and it looks like they are already securing gas turbines to bridge the gap.
The call really highlighted their deep ties with the semiconductor industry.
The exclusivity with NVIDIA for chips was a huge takeaway. It suggests they've solidified future capacity in a very scarce market.
And the AI satellite could launch as early as next year, which is a major jump from the original 2028 timeline.
Nick Gerli is highlighting a massive warning from DR Horton, where cancellation rates have spiked to 20%.
Is that just a one-off, or are we looking at a broader trend in the market?
It follows a similar warning from Lennar, and since these two builders control almost 25% of the market, their struggles pack a lot of weight.
The core thesis here is that the housing market is hitting a wall as mortgage rates and high prices finally exhaust buyer demand.
Builders have been buying down rates to keep sales moving, but Nick argues they can no longer fully offset the impact of 7% interest.
So the growth period for new construction might finally be over?
Current data shows over 9 months of supply on builder lots, which is 40% higher than the long-term average.
Didn't we only see supply levels that high during the 2008 financial crisis?
Exactly. Historically, supply hitting these levels has always coincided with a major U.S. recession.
A shocking revelation is that 82% of Horton's sales are now financed through their own mortgage arm.
Even more concerning, nearly 2/3 of those mortgages are FHA or VA loans with low down payments.
It sounds like they are propping up sales by taking on much riskier borrowers than in the past.
Despite a supposedly strong labor market, 15.2% of FHA purchase loans are already delinquent.
1 out of 6 first-time buyers is already behind? That seems incredibly high for a non-recessionary period.
It is the highest delinquency rate we have seen since the 2011 and 2012 period. Nick predicts that builders have no choice but to start slashing prices significantly to move their sitting inventory.
We are already seeing short sales in new communities, with price drops exceeding $100,000 in some cases.
If buyers can't qualify at current prices, the market has to reset downward.
The real danger lies in what happens if the unemployment rate moves from 4.2% toward 6%.
Nick suggests those FHA delinquency rates could easily climb to 25 or 30% in a downturn.
That would represent a catastrophic level of default for the broader housing market.
Keep your eyes on that 15.2% delinquency rate as a primary indicator.
If it continues to rise while the economy softens, the builders' ability to defend their pricing will completely vanish.
Today's pre-market focus is entirely on the 8:30 a.m. critical labor report, which deWolf suggests is the market's current skeleton key.
The stakes are high. The report will likely dictate if the Federal Reserve maintains rates, raises them, or considers a buffer based on job growth.
What are we actually looking for in the numbers to know if it is a hot or cold report?
The market is watching the non-farm payroll number closely to see how many jobs were added, alongside average hourly earnings and the unemployment rate.
deWolf argues that the non-farm payroll number is the key reference point for whether there is still a buffer in the economy.
Exactly. If the jobs report is weak while inflation remains hot, it creates a difficult combination for policymakers to navigate.
Is there really a chance they would hike rates again if the labor market shows signs of cracking?
It was reported that officials told the Financial Times a rate hike could still be on the table, depending on the data.
The data just hit, and the non-farm payroll number came in at negative 23,000, which is a massive divergence from the 85,000 estimate.
However, the unemployment rate actually sank 10 basis points to 4.1%, and hourly earnings were cool at 0.1%.
How can we lose 23,000 jobs and yet have the unemployment rate go down?
It likely involves seasonal adjustments. Many of those losses were in leisure and hospitality, following the conclusion of the World Cup.
The market seems to be responding favorably to the lack of a wage price spiral.
The average hourly earnings coming in at 0.1% is a sign that inflationary pressure from wages is muted.
Technically, the NQ futures are looking at 30,000 as a major psychological and resistance level.
We are seeing a gap up into the previous day's high, but we need to see if the buyers can hold these levels through the session.
If the value area does not overlap to the downside on a pullback, what should we expect?
deWolf suggests the odds of a late-day rally increase in that scenario, as shorts are forced to cover before the weekend.
Looking at the top-down analysis, the 4-hour charts are still showing constructive higher lows.
As long as we support levels like 7,750 on the ES, the trend remains bullishly intact for a move towards 7,820.
As we head into the weekend, the analyst emphasizes the importance of Friday rules.
If you are green, keep it green. Don't do anything silly that you will regret when you are at brunch on Saturday morning.
So basically, if you have a profit, protect it and do not chase the market if it gets grindy.
Precisely. Respectful, responsible, and resilient trading is the name of the game today.
And that's the full rundown for today. Want the final verdict, where these experts agree and where they clash head-to-head? It's in the video linked below.
Give this a like if it saved you time, and subscribe so you don't miss tomorrow's breakdown.